Welcome to our Taking Stock video for the week ending the 24th of February 2023. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. I know it's a busy time for you, especially with the reporting season in full swing.
Yeah, very busy week, Kien, but I'm glad to be joining you for the first time this year. We've got a whole heap of good content to get through today, don't we?
Oh, absolutely. But before we get through that content, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts, tables presented shouldn't be relied upon as a guide for future performance. So speaking about reporting season, themes are emerging with many companies struggling to meet market expectations on their profit margins despite a rise in sales. And the chart on screen really shows this, with downgrades having outnumbered upgrades for earnings, margins, and dividends.
Yeah, it has been a bit like that, hasn't it, Ken? And businesses have been able to raise their prices in this inflationary environment, but not to the full extent to fully offset the impact of higher costs, especially where wages and energy are a big component of the cost base. So this has led to weakness across operating cash flows also, with numerous companies preferring to preserve some capital into potentially some weakness economically in the next 12 months, with dividends coming in a little bit softer than we had expected initially.
Yes, weaker cash flows is a key theme, but what comes with weaker cash flows and rising debt costs as well, with rising interest rates, is it's putting pressure on financially weak businesses. And that's observed with Star Entertainment Group, which reported a 1.3 billion loss and is now undertaking an 800 million capital raising. So this will, of course, further dilute the value to shareholders who have lost over about 50% in the last 12 months.
Tough for those Star shareholders, isn't it? So with the financial tightening theme likely to continue this year, we can't reiterate enough the risks involved in investing in financially unhealthy businesses. And EML Payments is a pretty good example of that. This is the payments and gift card business in yet another disappointing development this week. We're pretty much forced to impair about $120 million in assets, and this stems from ongoing regulatory problems and leadership changes continuing to weigh down that share price. It's almost been an endless battle for the long-term shareholders in that particular stock. And BrainChip is another one, which was a market darling not so long ago. This is a software company focused on AI and machine learning, and that continues to generate negative cash flows and has declined peak to trough about 50% this year. But now on to the Star stocks and the highlights for this week.
Yeah, within our Star universe, Matt, NIB Holdings, a private health insurer, they released their first half 23 results. And interestingly, while the group managed to deliver revenue growth of 9% on the back of a strong recovery in international and travel insurance, the market reacted quite poorly, and it was down about 12% at the close. Matt, what do you see here?
Yeah, it was a big move on the day, and we spoke about this issue I think on Lincoln Live earlier in the week, and the market was surprised by the faster than expected compression in its net margins. So for those that aren't aware, net margins is the difference between premiums earned and the claims paid. Now, if you can recall back during COVID, many of us who held private health insurance couldn't access those ancillary services such as dental work or visiting the optometrist, for example. And this did allow NIB's net margins to expand from the usual 6 to 7% range to about 10% in FY21 and 22. But as Australia has been fully open for over 12 months now, claims activities is recovering, and margins should therefore revert back to those historical levels. So the market was probably just a bit surprised by the pace at which those margins did compress in this particular half.
Yeah, that makes a lot of sense. We have observed quite a few companies this season report COVID tailwinds becoming headwinds due to the higher watermarks in the comparative periods. But we still believe NIB is well placed to deliver earnings growth and sustainable dividend yields on the back of this rising interest rates, which should support its premium growth with the inflation, and also its investment portfolio as well, which invests in some of those fixed interest securities. But the stock is currently trading on a financial year 23 gross dividend yield of 5.2%. and it's also due to go ex-dividend next week on the 2nd of March. So those who are interested in getting that income can do so. Over the week, Challenger Limited, Australia's leading provider of annuity products, they were reintroduced into our Star Stock universe due to favourable trading conditions, Matt.
Yeah, that's right, Kien. And rising interest rates have underscored a lift in Challenger's annuity rates. And furthermore, strong investor demand for annuities over the last 6 months, especially from retail investors in Japan, if you could believe that, is likely to continue. And as interest rates are more likely to remain elevated in the near term, this could continue to foster an extremely favourable environment for Challenger to grow its earnings. And meanwhile, the stock is trading on a FY23 gross dividend yield of about 4.85%, so fairly attractive. And it did recently go ex-dividend. So if you are looking for that income, you're going to have to wait for another 6 months to get there if you haven't purchased a position yet. With margins and profitability in decline, it is inevitable to see a few stocks fall out from our Star Stock portfolios throughout the reporting period. And some of those have included PWR Holdings, South32, Beach Petroleum, and carsales.com. So please refer to exit commentaries for more information on these particular exits.
Yeah, it's disappointing that some of these good quality businesses have been removed, but it's the nature of the cycle, Matt. You know, when some of these cyclical businesses, when they're not earning enough, it's time for us to remove them. And, within the retail sector, we also had to remove Adairs and also JB Hi-Fi from coverage, unfortunately. Consumer spending has declined in recent months as inflationary pressures and higher interest rates, they bite the hip pocket. In addition, you've got earnings across these two stocks. They are exposed to the weaker housing market, such as homewares and white goods as well. And just to reference, the market is currently forecasting Adairs and JB Hi-Fi earnings to decline by about 8% and 7% respectively over financial year 23 and even further in financial year 24.
But it's not all doom and gloom in retail land, is it, Ken? Certainly one of the retail holdings that find favourably in our portfolios is the fast fashion retailer Lovisa. And they have been able to defy much of the challenging economic conditions and deliver a pretty positive result for the first half of 23. This is all about that global rollout strategy, isn't it, Ken? And they've been able to deliver on that. The low basket size per transaction means that consumers are less likely to think twice before making purchases. So sales and like-for-like sales have continued to tick higher, and the company continues to roll out stores at a global scale. So it's a really exciting business and a really solid result.
Yeah, and that's why the forward growth expectations for Lovisa is still quite positive. And Matt, you're right. To combat headwinds within the sector, these retailers really need to be nimble. They need to have a niche or competitive advantage and a growth strategy behind that. And Lovisa is a great example. Okay, now next week will be another big week with the release of many Star Stock results and stocks going ex-dividend. So please refer to our corporate calendar for more details on this. In Under the Microscope this week, we take a look at the largest company listed on the ASX, BHP Group. Upon further review of BHP's result, we have had to cease coverage of its star growth status. However, we've retained it as a star income stock. Why is this, Matt?
Yeah, it's interesting that we've removed them from the growth universe, but as you said before, all of these things need to be considered for future growth potential. So BHP has been the beneficiary, obviously, of record iron ore prices over the last 2 years, which has seen its earnings, cash flows, and those dividends rise extremely high. And we're now seeing commodity prices starting to roll over to some extent. And normalise, and that means that record profitability that they've been able to achieve over those last few years is starting to fall, and it's annualising really high return on invested capital. And the tolerance allowed for our star stock criteria is such that we've had to cease coverage from a star growth stock perspective. Yeah,
that's right, Matt. I mean, the trend in that return on invested capital and also earnings growth is negative over the next 2 years, as you can see on Stock Doctor. So it doesn't make sense for it to still be a growth stock at this stage. But despite this, dividends also fell by about 40% year on year, now to about 90 US cents. But we've retained BHP as a star income stock, and some investors would be asking why that is the case given this significant fall.
It's a good question. I mean, mining companies are not traditional income stocks, so their dividends are obviously highly reliant on the underlying commodity prices. So it's not uncommon to see this large variability in the dividends. And we've retained BHP as an income stock now because, firstly, despite the fact that the dividend has fallen 40%, it's still extremely attractive. The gross dividend yield for the company is 9%, which is well above the market average, and it is providing some buffer in the event that dividends are reduced. And in addition to that, free cash flow remains above expected dividends despite a lower trend forecast for the next couple of years.
Yeah, that's right, Matt. But there are also some, I guess, some fundamental factors keeping the iron ore afloat as well, such as production problems across the Brazilian miner Vale, which should also restrain the supply and support prices. So how are you feeling, Matt, about this near-term outlook for commodities overall, and whether the risks outweigh the potential rewards for a company like BHP?
Well, look, we acknowledge that the outlook for commodities is challenged given the slowing growth dynamic, which is being squeezed by rising interest rates globally. But this slowdown in demand is typically negative for commodities, but prices are remaining firm for now as China and that reopening sort of narrative starts to reignite its economy. So overall, we feel BHP and its gross dividend yield of 9% is attractive enough for us to continue holding the stock for now.
Yes, but we are also mindful that the resource cycle can change quite quickly, and we'll be keeping a close eye on this stock, including movements in the underlying commodity price as well. So check out those earnings revisions, which tends to be a good indicator of where commodity prices are going. But due to the company's exposure to volatile commodity prices, this investment may not be suitable for those more defensive income investors. And with reporting season in full swing, some of the issues confronting investors, I guess, is that it's practically near impossible to avoid having a few disappointments. Hence, the question of this week really is, how do investors deal with a significant negative share price reaction within their portfolio? But the best approach in dealing with this, though, is really to have risk management strategies in place. According to Nobel Prize winner Harry Markowitz, he mentioned that diversification is the only free lunch in investing. So by holding a well-balanced portfolio, you effectively reduce the impact of your overall portfolio if a significant loss arises.
And if you were trend sensitive, consider applying one of our technical indicators such as SD Max and SD30 TSR. Here you need to be quite systematic with your approach and sell out of a stock once it turns bearish or triggers your stop loss. However, if you are fundamentally orientated, as we are in the managed investments team, and tend to view share price weakness as a good opportunity, it would be best to ensure that you read our commentary specifically around the active risks to understand why the share price has reacted the way that it has. And be objective and leave your emotions at the door. Assess the stock according to your return and risk objectives and ask yourself these questions. Has its financial health deteriorated? And if so, you'd remove the stock due to the increased risk of insolvency. Are the active risks transitory or expected to linger over the next year? Is the dividend sustainable and will it meet your income requirements for the year ahead? And are there better opportunities elsewhere? And could I potentially offset my realised gain with these losses for tax purposes?
Yeah, and you'll find much of this information in our analyst commentary, but of course, feel free to pick up the phone and talk to our analyst team or our client services team if you have any questions on this. Remember, it's almost impossible to get everything right, and there will be some losses in your portfolio inevitably, but the aim here is to really cut your losses and let your profits run. Do not hold on to stocks on hope that it will recover. Rather, be objective and reallocate. Remember, you can reallocate those funds to better opportunities rather than hold on to losing investments. That's all we have time for, but thanks, Matt, again for your wonderful insights today.
No, thanks for having me, Kien.
And just a reminder that our Lincoln Live webinar is on Monday. where Matt and myself and Tim Lincoln and also Rob Manfrey will be there to help answer your questions on stocks, portfolio strategy, or how to use Stock Doctor. But now to summarize today's episode, we're seeing these themes coming from reporting season. You've got weaker margins, cash flows also are emerging, which are softer. But what does that mean? That means that investors really should focus on those financially healthy businesses that can ride out these challenging conditions. Also, ensure you review our comments on the active risks if you are unsure of what to do following significant share price reactions. Take care and have a happy, healthy, and prosperous week, everyone.